Well, hello and a very warm welcome to the New Look Macro Mondays. I'm Lisa Aziz, your host, and with me in the studio today are James Brodie and James Todd. Morning to you guys.
Good morning.
Good to have you here. Just remind our viewers actually first up what it is you do, which particular areas you cover here in oil and derivatives.
Well, I'm a former trader, having worked in London, New York, Tokyo and Singapore, and now I'm head of Flux Institute, which is a learning part of Onyx.
Really important.
I started as a trader on the light ends desk and then now a trader performance manager here at Onyx Commodities.
Excellent. Plenty of expertise. Right, what then is Macro Mondays? Let me tell you more. Each week we aim to cut through the noise to bring you the key global macro stories, the trends, charts, risks and trades that matter the most. So in the next 30 minutes or so, we're going to be taking a deeper dive, especially this week, into those volatile US equities. Why are the markets opening weaker today? Closer to home, after last week's big budget, we'll be asking what's the market focusing on just now, though? Plus, what's driving the commodity market surge? We'll have an update for you live from Dubai, and stay tuned right until the end when we'll be sharing details with you of our brand new Onyx training courses available online and at our London offices alongside our new traders. Lots to cover off then. Let's get stuck in to James Brodie first up. Shall we have a focus then on that weakening US economic data, James, that we've seen emerge particularly in recent days? How would you sum up that picture?
Absolutely. It continues to deteriorate, Lisa. Retail sales came out last week, expected to be up 0.5% month on month. They came in dead flat. Also, consumer confidence, that's fallen. That was expected to come in at 93.3, came in at 88.7. Again, much weaker than expected. The only up point from consumers where they think equities continue to go higher. But if we look further afield as well, German quarterly GDP came in flat, 0.0%, which is pretty poor. But the flip side, there is some good news out there. Canadian GDP came up quarter on quarter, up 0.6%. That was expected to be negative. And India GDP came in up 8.2%. But we're actually getting some results now already from the Black Friday sales. And what we early signs are showing that prices were up 0.7%. But volumes were down.
Yeah,
volumes
I mean,
down 1%.
Obviously this is a time of year where retail sales in the US are expected to pick up, going into winter. It's the pattern of consumption generally, but to have no growth in month on month retail sales is, it's a pretty worrying alarm sign. And, ultimately the projection forecast will typically be higher in October, November, even higher in December. But if we're flatlining here, either the expectation is going to really be significant now to be on parity with where we want it to be in December, or we're just going to be falling short consistently, which I think is what's more likely. Yeah,
and for consumers all over the world, of course, it doesn't help if inflation is continuing to drive products upwards. I mean, who can afford it?
Absolutely.
Yeah, and on that, my point actually there, prices are up 7% coming out from Black Friday, 0.7, that's my area. So prices are up 7%, but volumes are down 1%. And if we look at the chart, the 2 year here, you can see, well, this is going all the way back to COVID, and you can see it's getting narrower and narrower and narrower. And actually we're getting towards this support that's coming at 3.4%. Problem the Fed have is the economy is slowing, which means they'll have to cut. And there's 85 basis points of cuts priced in over the next year. But if this filters through to inflation, they won't be able to cut. So, I mean, from a trading perspective, you have to wait here, and there's a chance if inflation picks up, they won't be cutting as aggressively, and actually yields can start to spike higher in the short end. So this is a case of wait and see.
Do we think we're still expecting that cut on the 10th?
There's definitely going to be a cut of 25. That's fully priced, but it's where we go after that. But we've got a busy December because then we have the Bank of England and the Japanese central bank on the 18th and 19th. Bank of England's expected to have a full 25-point cut, but now the market's expecting Bank of Japan to hike, which is why the equity markets are suddenly starting to fall this morning.
You don't think Jerome and his motley crew could pull a surprise and say, we haven't seen enough data in order to cut? Or, I mean, I guess the pricing, it seems to be fully baked in, but could he pull the rug from under everyone's feet?
I don't think they will, because they always like to lead the market. So I think it's back since the financial crisis, they've not surprised the market. So a couple of weeks ago, it was priced at 30% chance they cut. And they talked to the market, known as jawboning. They led the market that there's going to be a cut. I think the last thing they want to do is surprise the market, because then you get much more volatility in asset prices.
Right, let us now bring things much closer to home. What's happening in the UK after the much-awaited budget? Well, it finally came to pass, didn't it, last week? How's the market been reacting?
Actually, just before we get to the UK, another chart worth looking at here is the split economy in the US. Manufacturing continues to contract while we see AI leading the way here. So you can see more than half of the 1.6% of US GDP growth in the first 6 months of the year came from AI-related spending. On the flip side, another piece of just regional data we had last week, the Chicago PMI, that fell to 36.3 from 45.5. This is a big manufacturing hub. So you can see all the growths in AI spending and the manufacturing hubs are really weakening. So you're getting this real two-tier economy in the US. And also in the US, if we move on to the next chart, you can see, well, this is the dollar index. And you can see we had this period earlier in the year, it sold off aggressively. It went sideways. It looked like it's going to break higher. But now actually at the last week, it started to go down again. And we're actually seeing property prices in the US falling aggressively. This is data from Zillow, and particularly in Florida. See, Orlando's down 4.5%, Tampa's down 5.1%, but then Palm Beach 5.9%, Key West is down 6.9%. It gets worse. Cape Coral down 10.4%. Fort Myers down 12.1%.
So, I mean, all of these things, if you look at manufacturing, property prices and dollar index, they're all coming off. And so the traditional analysts who are looking at historical figures will be looking at that saying, all right, we're really, up a creek without a paddle regarding the US economy. And yet the things that are perhaps more revolutionary to the economy, the AI boom that, they seem to have a preeminence in, especially with chip manufacturing, etc. That seems to be still, despite the volatility, supporting the economy. And of course, you just don't have the historical comparisons with that. So the traditional signs of the economy failing and flailing are there, but the new growth sectors are, still supporting things.
Yep. And one problem I'd say is it's very localized, where you have these growth sectors and of course the manufacturing hubs, which are continuing to weaken. Another chart briefly as well. I mentioned German Q3 GDP came in dead flat. And you can see French PPI actually is in deflation, down 0.8% year on year. German unemployment 6.3%. So Europe, we haven't talked about that much because it's becoming less and less significant in the global GDP. But the data is pretty weak. And here's a chart of euro yen. You can see it's trading here up at 180. The yen suddenly strengthening this morning. Again, the market's pricing in 20 basis points of hikes on the 19th of December. Yen's up. Bitcoin's off 4%, Ethereum's down 5%, US equities are starting weaker. But this might be the time for yen to reverse. And you can see it's trading at 180. This was trading at 114 during COVID. So that'll be an interesting one to see how that plays out.
All right, close to home.
Yep, on the UK. Of course, we had the budget last week. Again, it's similar chart. You can see here, very similar chart. This is the UK 2-year bond yield, very similar to the US. It's getting a narrower and narrower range. Again, which way is it going to break? If I was to have a trading view, I wouldn't have a trade on here. I'd wait to see if inflation concerns rise, I'd just see it just break higher. My concern with the UK is the economy is weakening. We get the employment data on the 16th of December, just 2 days before the Bank of England meet. That's fully priced for a cut. If we see employment continue to deteriorate, currently at 5%, then yields will break lower.
We saw, you referenced jawboning with Jerome Powell and the US Fed. Rachel Reeves sort of, perhaps you could describe it as jawboning, but I think was throwing as much mud at whatever wall she could find before the budget. And I think the market was relatively confused. But as if you look at stuff like what we face here, we're in a range where, it's not going to break down to the downside or to the upside without some significant headlines. So it seems to be a bit range bound, but the underlying is weak. And I would not be surprised if that unemployment data on the 16th is pretty terrible as well.
Yeah, if we have a cut in December, then there's only one full cut priced after that next year. So again, weaker data, the market will suddenly start to reprice 2 cuts next year, possibly 3, and we'd see yields breaking lower.
We've covered a lot of this off. Back to the States, though, if we may. Just take us through a little bit more of the volatility that's faced equities out there, the key drivers, and also the currency markets, the key ones.
Yeah, if we look at the S&P here, you can see, again, we've mentioned this before, it's very close to a strong rally the last week. It's very close to all-time highs again. 6,920 is the all-time high. You've got a big double bottom support here at 6,540. We typically get a Santa Claus rally into year end, but this morning the market's breaking lower. And the market seems to be pretty nervous about these Japanese yields. I mean, Tully, what are your thoughts here?
I mean, I think it's quite interesting if you look, we've discussed Oracle before, but the fact that Oracle now, the credit default swaps are so high on that they're probably not going to be able to actually fund their forward deliveries of NVIDIA chips, etc. You've got everything kind of blowing out to the upside on this AI boom. But if you start to see people not actually being able to purchase, the goods, and ultimately Q1, Q2 bottom line reports could be, really terrible, that's just going to take all of the air out of the balloons.
Yep. It's interesting. We've seen NVIDIA start to fall aggressively. If you look at the next chart, you can see actually S&P 500 corporates are in very good health. So S&P 500 debt is at record lows. Meanwhile, you can see here the government debt is close to record highs. So the corporates on the whole, their balance sheets are pretty strong and their earnings are good. But if we move on to the next chart, they do have very high values. So this is the S&P 500 price to book value ratio. And again, it could be different this time because AI stocks have a lot less costs, a lot less fixed costs. But then the next chart highlights, quite interestingly, the divergence we're seeing now within the AI sector. So this is Google, which is suddenly surging higher, and NVIDIA, which is breaking lower. And it's not just NVIDIA going down, SoftBank, Microsoft have been going lower as well. SoftBank's highly leveraged bet on AI. But the flip side, Alphabet, Google here is going up, along with Broadcom, Celestica, and Intel jumped on Friday night 10% on rumours. There's no news, but rumours they're going to help Alphabet with building new chips.
It seems to be almost a story of Alphabet and Google, versus Microsoft, NVIDIA. And we've been seeing these circles of money going around between Microsoft, NVIDIA, et cetera, a number of banks, just number of companies lending each other money, but committing to purchase future contracts from them. Google seems to be doing really quite well, and NVIDIA's Twitter account, made an announcement last week, basically congratulating Google on its, AI and its manufacturing. Still saying NVIDIA's stuff is better, but it was, I think, sort of said through very
tempered with a bit of jealousy, perhaps.
Absolutely. So I think it's going to be a story going forward over the next 12, 18 months of Google and their development versus the NVIDIA, Microsoft sort of preeminent guys.
Yeah, what was interesting about a month ago, we had a sell-off in tech and AI stocks, and it was across the board. But now the market's starting to say, actually, well, it shouldn't be across the board. What are the good stocks we can pick? So they're moving out of NVIDIA, which was very leveraged, and into other stocks like the Intels now and the Googles. So market's not deserting equities and the NASDAQ. It's actually trying to move, as you say, rotate from one stock to the next.
It's a shame that we don't have some of those mega companies over here, more homegrown.
Absolutely. I mean, that's a problem that Europe's going to be facing for a long time. And, all of the companies that we're talking about having a potential rivalry, the incumbent firms, the new challengers, they're all based either in Far East Asia or in the US. And, Europe's going to be left behind.
Because we had that news recently, didn't we, about 2 data centres, I think, going to Wales in particular, which is all well and good, but none of that's going to happen overnight. And they all need lots of power to drive them.
Absolutely.
An interesting point on equities as well. If we look at margin debt in the US, this is data from FINRA. You can see margin debt is at record highs, increased by 57 billion in October to a record 1.2 trillion, 6th consecutive monthly increase. Now, you could say, is this a risk? There's record levels of margin debt. But the flip side is it's going up and there's more money coming in, which is driving asset prices higher. So it's a risk when it starts to turn and people look to get out of markets because they're highly leveraged. But for now, as we see with the US equities, the S&P can break to new all-time highs. New money's going to come in. And I personally think that's what's going to happen into New Year. And then all of a sudden we have to look at the data and reality, the market will sober up.
Yeah, it is also worth saying, as retail come into the game more and more, as a retail trader, you can deposit margin and be given some initial margin or variable margin loans by your sort of regular retail sort of trading websites and that sort of thing. So the number of people who are able to put on a trade has increased. And as a result, I think it's not necessarily a surprise that margin debt would be going upwards overall. But to see, as you say, such a sharp line up, perhaps indicates either that more people are sticking on highly leveraged trades or more people are out of the money.
And a really important point with this as well is, as you say, what is leverage? Well, let's say I have $10,000 to invest. Well, I can get leverage from the broker that they'll let me invest up to certain places up to 10 times, up to 100,000. So it means, of course, I can buy much more, which is great when the market goes up, consumer confidence goes up, people are spending. Problem is when it breaks lower, of course, your losses are that much bigger. And that's what we saw in the financial crisis. So as we said, it's all very well when it's going up. The speed of the rise concerns me, but it's not a problem till the market breaks lower, and it's beyond 5%. If the Nasdaq starts to go 10, 15% lower, that's when this really hurts. And again, it's the retail traders that get hurt on this.
Yeah,
and that's why you can see really dramatic, price action, particularly in equities, etc. If everyone's been long, I don't know, Palantir or NVIDIA, and it starts to break out, what doesn't happen is you don't just sort of think, oh, I've lost, 15% of my amount deposited. You get stopped out by your prime mortgage broker, basically, and your prime lender. And that's why everyone all of a sudden at these herd levels have to sell. And it doesn't matter what level you're selling, it's done. So the equity price just breaks lower.
Right, should we have a focus on currencies and the yen in particular?
Yes, we've had a big move in the yen today. So 2-year yields have broken up above 1% for the first time since, I believe, the financial crisis. They've gone up 5 basis points. That's a huge move. The 10-year's gone up 7 basis points. Again, these are huge moves. And the yen is now strengthening on the back of that. Look at the chart here. It's an old favorite we bring in. This is a correlation between dollar yen in orange and the 10-year interest rate differentials in white. And you can see correlations broken. Everybody's been selling the yen for particularly this year aggressively. So dollar yen's been going up. Well, today, actually, dollar yen started to fall. Yen's strengthening. Equity markets are falling off the back of it. The Nikkei's down 2%. Your Bitcoin is down 4.5%. Ethereum's down 5%. So it's a bit of a messy start to the week. US equities are only down. Nasdaq's down less than 1%. But become interesting if it's a highly crowded trade. When yen rates were so low, and the carry trade is, it means you can borrow money in Japan at really low rates. You can transfer it across the currency exchange and then buy assets in other countries very cheaply. So it's being used to fund asset buying. As yields start to go up, that disappears. And interesting to see if this correlation starts to come back. But I think a lot of people have lost a lot of money on this trade particularly. But it is very crowded trade, the dollar yen. So it'd be interesting to see how that turns out.
Do you think it will stabilise over Christmas?
I would have thought
days ahead?
I think this divergence is going to carry on ultimately if you're seeing, the Fed cutting more and BOJ looking to hike more and more going forward. So it makes sense as to why there was such a good relationship, especially over the sort of past 5-year cycle with the interest rates in Japan being so low. But with this change in interest rate differentials, I'm not sure that this is going to be.
Yeah, that means this white line is going to come down more aggressively.
Yeah.
So it's a case of, will it be the critical string that breaks this trade's back, dollar yen?
Right. Okay. Let's shift on to commodities, round them up, particularly silver.
Yep, silver, we discussed this last week actually, about to break high. Silver, you can see here, is broken aggressively higher. Had a huge move on Friday through key level 54.48. That's off to new all-time highs, and the market's going to chase that.
What's driving that?
Market's rotating back into precious metals. It's been a favoured trade. We've seen this all the way through last year as well. You get a big aggressive rally in these crowded trades. They go too far too quickly. You may remember back in sort of October, there was pictures in Sydney of people going to these retail shops to buy gold, and they were queuing up all around the corners across the streets. When it gets that crowded, you get these sell-offs, but now all that, as you say, frothy investments being taken out, and now it's starting to naturally break higher again.
Yeah, I think also it's worth noting where, we'll come on to gold as well. If we move on to the next chart, we see that gold is sort of hovering near the all-time highs there, just below. It's broken out to the upside of that convergence sort of structure. But both gold and silver, precious metals, they're liked by central banks. And central banks basically want to steadily scale in to these precious metals, I think it's fair to say. So ride out a bit of the volatility by providing sort of a regular bid in the markets, and that they're going to be a buyer at a certain time of the month and that sort of thing. So I think we're going to be seeing periodic and not necessarily wholly sustained support for these precious metals, but it will come in. And so when you have a bid from the central bank, the wind can come back in the sales, retail can latch on and think, okay, the momentum's back up. Particularly if you look at, I mean, gold is going to be hovering, I think, below its all-time high for a good while now.
That's gold here.
And but if we go back, well, in the chart from silver, we saw it's breaking above even the all-time high that was in 2011. So trading a breakout, you don't really want to be on the, on the offer. You don't want to be on the sell side, because this could, whilst it probably won't go parabolic, it could go up and up and up. So I think we'll see retail sort of supporting it and central banks on the buy side as well.
Yeah, good example of commodities going, or assets going parabolic. Back in 2011, silver went from $8 to $49.9 in 18 months. An interesting one with gold as well is Tether have been buying more gold than the central banks combined in the last couple of months. That's only just come out. So they've been diversifying out of buying crypto. So we've seen MicroStrategy, of course, that's been collapsing. They're just long solely of crypto, but Tether's actually quite smartly starting to rotate out of crypto and into gold. So that's supporting that market as well. An interesting commodity, if we go on as well, is this one here, copper. You can see copper is at new all-time highs there, and that's going back to 2000. So it shows you some of the volatility we had here through the financial crisis. And this is very different because it's not a precious metal. Central banks aren't buying it.
We've talked a lot about copper in recent weeks, haven't we?
Yep. So favourite this and uranium because they're critical for electric vehicles. They're critical for the AI data centres, power. And we know in the long term, there's going to be a shortage of them. So these seem good fundamental trades, and technically they're breaking higher as well. And one other one, Brent. Very briefly before we move over, Brent, the long-term chart here of Brent, you can see the lows it got to during COVID. You can see the peaks it got to when Russia invaded Ukraine, but volatility's continued to fall. You can see from the long-term chart.
Yeah, absolutely. Well, and having just seen that chart, actually, to James's, what about we get a live update now on the energy markets from our all-knowing crude expert, Jorge Montepeque over in Dubai.
Hello, everyone. It's Monday from Dubai, and we're celebrating here the National Day. But guess what? We're still working. All of us are still working. So what has happened? A lot happened over the weekend. Primarily, the meeting between the Ukrainians and the Americans in Miami. And at the end of the meeting, the word used was productive. It was a productive meeting. In diplomat speak, that means we didn't achieve anything. It didn't work out. Productive means work in progress. And that means the boom boom continues. If you check in your feed, you will see the picture of the diplomats as they ended. And no one looked any happy at all. Witkoff has to go to Russia and tell Putin that there was not much progress. So this means it's still bullish for the market, and the market opened a lot higher. At the moment, we are about 2% up from Friday. So the market is interpreting all these things as bullish as they should, because there is no apparent real progress in the war. In addition, OPEC had a meeting yesterday, Sunday, and they decided to signal a little bit bullish things. They decided to keep the production levels unchanged all through the first quarter. And we all know that it's all fake. All the production levels they announce, it's fakery, really. But at least now they're getting on with the program that they cannot talk so bearishly and then expect the market to go up. So what are the things that happen? Well, we have maybe snowstorm in New York for this coming weekend. This is early for this time of the year to have these cold waves. Refinery went down in Malaysia. That's also bullish for the product markets because there is so much need for heating oil globally. So any refinery that gets hurt is a bad thing. And then in addition, the Ukrainians bombed and took credit for attacking a couple of vessels in international waters. And there was also one off the coast of Senegal, as we understand. All these things means the war continues to extend. And if it happens outside of the ambit between Russia and Ukraine and now extends to waters close to Turkey or other places, well, it's bad and it's bullish for the market. Some of the people we spoke to this morning were asking us how we interpreted the market direction. And we said, well, if we take everything on the aggregate, it's a bullish ride. And but they disagreed. They felt that the market could go any other way. But why? The levels of production are not increasing, are they? And the Russians and the Ukrainians are not kissing up and making up. So we say for this week, to the upside.
View there from Dubai. Jorge, thank you very much indeed. Right, back to the studio then. Should we just check in on the crypto crash? Still ongoing?
Yeah, that still continues to go lower. As we mentioned already, it's gone, it's fallen. Bitcoin's fallen 4.5% today. You can see it's way off its highs. You can see it's about to take out this 77,000 level. It's converging towards that. If that breaks, you're going to get more stops triggered. People say it's a store of value, but it's down 6% on the year, whereas silver's up 96%. So it doesn't look particularly good store of value.
I think the FOMO idea is out of crypto markets at the moment. So you don't see sort of social media engagement that's driving supporters and encouraging it to be near its all-time highs. And I wouldn't be surprised if we would see, I don't think it's going to be as dramatic a sell-off here down to maybe, I don't know, $66,000, but I could see it drifting for a while now.
We've had multiple sell-offs since sort of 2019. I think was the first one of 80%. I mean, that's, again, for leverage plays, that's catastrophic. Interesting chart here as well. Bitcoin against US credit spreads. You can see quite a lot of correlation there. Mm-hmm. And of course, the big credit spread, as you mentioned, James, is Oracle that's been of news. Question comes, is this the canary in the coal mine? But the equity markets seem to say no. They continue to grind higher. But again, I think the next key piece of data out in the US really is employment data, which comes out on the 16th of December after the Fed meeting. But that will give us a new update on the state of the US economy.
Well, indeed. And we've touched on the possible movement by the US Central Bank, of course, certainly on the 10th of December. What about thoughts on others, though, cutting their rates?
Yeah, interestingly, we touched on last week, apart from the Fed and the Bank of England, no other central banks have really any cuts priced. What you now have actually in Australia and New Zealand is the market starting to price hikes later next year. So the market's saying, this will be the bottom of the cutting cycle. So the market's starting to pick a recovery going forward. Interestingly, the BOJ as well, the market's pricing 2 hikes over the next year. Markets at the moment pricing 20 basis points for December 19th. So interestingly, going into year end, that could cause a lot of volatility. 2 central bank meetings, or Bank of England, the Fed, Bank of Japan, key economic data. The Bank of Japan actually hiked rates once on Christmas Day.
I was just going to ask whether we thought any surprises could be in store, and I don't know, the Japanese or the Australians perhaps going crazy on Christmas.
Yeah, Bank of Japan wouldn't surprise me to say they've done it before. That sent the financial markets into turmoil, of course.
Yeah.
They were in on the day and everyone else was out.
And everyone choking on their turkey as a result.
Yeah.
Right, let's take a look then at what key data and events are happening this week. What should we all be looking out for?
Interesting one today. We have the PMI's Purchasing Managers Index from Eurozone, UK and US. This is a manufacturing, so it's the Fusion Index. A plus above 50 is expansion, below 50 contraction. US was last out at 48.8, I believe it was. Markets expecting a slight tick up, but again, still expecting contraction. On Tuesday, we have Eurozone CPI and unemployment. Wednesday, Eurozone, UK, US PMI for service industry. That's where the strength has been. Also, Australian GDP and US ADP employment. Thursday, Eurozone retail sales, US jobless claims. And on Friday, Eurozone GDP, Canadian employment, US PCE deflator, the inflation index at the Fed favour, and University of Michigan consumer sentiment.
All right, busy one. Just before we go, actually, James B., just remind everyone where they can get plenty more information about your fantastic online and on-site courses. And you've got an update for us.
Yes, Flux Institute, we're doing face-to-face training with clients at their premises. We're doing it here. We're inviting people to join us here, and online training. We had a new course, European gas trading, went live on Friday, and we're starting to see sales already on that over the weekend.
Congratulations.
And you can find it, thank you. You can find it, of course, here on the QR code. That will take you to our website.
All the info you need. And that is it for this week's Macro Mondays. Thanks to James B and James T, and of course to you for watching. Remember, you can indeed get plenty more info about what we do over at flux.live, freemium, or that QR code on your screen. We will see you next week.